Hey guys, welcome to the KJ Methods YouTube channel. Welcome back to the KJ Methods YouTube channel. If you remember, we are now putting it all together. We started last week with questions 1 through 20. We are now working on questions 21 through 40. If you've been watching all along, I'm KJ from the KJ Method. I run this channel. I'm a real estate attorney as well as a pre-licensed instructor. We've been doing a number of series for the national exam, and now we are trying to put it all together to see if you actually got it. So we're back with a set of new questions for you to take a look at and see how you do. All right, without further ado, let's get started. Question 21, two siblings purchase a vacation home together, each contributing equally. Their deed states that upon one's death, the surviving sibling will own the property entirely. Which form of ownership was created? A, tenants in common. B, joint tenancy. C, tenants by the entirety. Or D, community property. Well, what are your clues here? Your clues are that they purchased it together, so we know it's co-ownership, but it also says that as soon as one dies, the other person gets it. And so that is classic what? B, joint tenancy. You got to know that. Next one. Maria buys a condominium. Which of the following best describes her ownership? A, fee simple ownership of her unit and an undivided interest in the common areas. B, stock ownership and a proprietary lease for her unit. C, sole ownership of air rights but not land rights. And D, leasehold estate in the unit with reversion to the association. So immediately you should be able to pick out that B and D are going to be wrong, right? This is not a lease and it is not a co-op. We only use proprietary lease in the term co-op. So we're back to A and C. Remember how I keep telling you that you have to be a good process of eliminator? Also, just get rid of those answers. Let's not even look at them. All right, so what is a condo? A condo is fee simple ownership in a unit, and you share the other stuff, the swimming pool, the parking lot, the playground, with everyone else as tenants in common, and those are called the common elements. So the answer here is A. 23. After showing multiple homes to Miss Renee, broker David learns that Miss Renee signed a buyer brokerage agreement with another firm 2 days earlier. David continues to assist her anyway because she asked him for help. A, David has created subagency with the other firm. B, David is acting as a transaction broker but is risking license law issues and a commission. C, David risked undisclosed dual agency by assisting Renee. D, David has ostensible agency only if the original broker approves. All right, guys, again, what is it asking me? What is going on here? Do you agree that David's helping this person and he learns she's represented? So 2 days before, she signed a buyer brokerage with someone else. So she's represented at this point and he's just helping her. So if anything, she's a customer, right? A third party to him, if anything, right? Which means he's only working in a transaction capacity. He can't be working, so C, it can't be undisclosed dual agency because he is not her agent. Don't forget that dual agency anyway requires that you have a person you're representing on both sides of the transaction. He is not representing her. He is just helping her. It can't be ostensible agency because ostensible agency is when you lead a person to believe, right? A third party. That's not what we have here. So either he's created a sub-agency with the other firm or he's acting as a transaction broker. So I said to you already, he is not representing her, so it can't be an agency. So he is a transaction broker, but he has a problem, right? He found out that she's already represented and he's still trying to help her. So he's risking a license law violation as well as a commission. Number 24. A homeowner's deed restriction prohibits commercial property, but new zoning law allows small home-based businesses in the area. The owner begins running a boutique from their home, citing the new zoning. The homeowners association sues to stop the activity. What do we have here? Deed restriction says no. Zoning says yes. What happens when you have that conflict? That's all you're looking for. What happens and what is the rule? So A, the zoning law overrides private restrictions. Is that true? Not all the time. B, the private restriction overrides zoning because the stricter control applies. Maybe. C, the homeowner is protected under grandfathered use. And D, both restrictions are void because of conflicting authority. What is the rule here? Anytime you see the stricter one prevails, when there's a conflict between private and public, that is going to be your answer. Guys, we don't care if the zoning was better. We don't care if the deed restriction was better. It's private and public. They're conflicting. So the answer here is going to be B. The private restriction overrides the zoning because it is stricter than the zoning. 25. After a buyer fails to close, the seller keeps the earnest money deposit based on a clause that sets it as liquidated damages. The buyer sues, claiming it's a penalty. A. The clause is enforceable only if the amount is reasonable and agreed to in advance. B. The clause is unenforceable because damages must be proven. C. The seller must return the earnest money unless harmed. D. The clause is invalid without attorney review. This one's easy peasy, right? Can you agree to liquidated damages? Yes, that's exactly what liquidated damages are, right? You're agreeing ahead of time. So we put it in there. We go, hey, if you don't close, I'm going to keep your earnest money. Can we do it? Sure, we can do it. And what the law really says is A. It is enforceable only if the amount is reasonable and agreed upon in advance. Now, that reasonable, I don't know, right? We generally don't have arguments about liquidated damages. This is what I mean by reasonable. Sometime maybe it'll say the person put down $100,000 and you breach. Can you keep the whole 100? They may argue that, hey, wait a minute, that's too much money to keep. But the thing is, if you agree to that amount of money, you agree to it. All right, so A, simple on this one. 26. Investor Allen owns 2 adjoining parcels separated by a private driveway he uses to access both lots. He sells one parcel, but he forgets to reserve an easement for access in the deed. After closing, the new owner blocks his driveway. All right? Please make sure you understand what is going on. He owns 2 lots. He sells one, and then he's like, oops, I can't get to my lot anymore. All right? What happens? A. Allen retains an easement by necessity since the landlocked parcel requires access. B. Allen's right of access terminated at sale. He must negotiate a new easement. C. Allen has an easement by prescription since he historically used the driveway. D. Allen has an easement in gross that transfers automatically. So what say you? The correct answer here is B. Allen's right of access terminated at sale. He must negotiate a new easement. Why is that? Because in reality, if he owned both parcels, there was never an easement to begin with, right? You agree with that? Remember we said when 2 parcels come under one ownership, we have a merger, and then there's no easement. So he did not have an easement to begin with. What we needed to do now is create an easement. And so A says he retains this easement by necessity. There was never an easement to begin with, and you don't retain an easement by necessity. You can get an easement by necessity if land is landlocked, right? But in this situation, because he was the one selling the property, what he needed to do is reserve an easement for himself because there was no easement. Since he didn't do that, he now is required to negotiate an easement. And let's say the person doesn't negotiate the easement with him. Well, then maybe he can go to court and get an easement by necessity. So correct answer here is B. 27. A sales associate tells a client, we can't show properties in that neighborhood. The residents might not be comfortable. So what do we have here? A, is this steering and violates fair housing laws? B, this is acceptable if the buyer requested similar areas. C, this is redlining because it excludes certain locations. Or D, this is blockbusting because it spreads panic selling. Well, this is a classic example of A, steering. A steering is when an associate tells you we can go here, we should go here, or we can't go here. They're essentially telling you where you can be and where you can't be, right? That is classic steering. Redlining, don't forget, is always done by a bank. And blockbusting is more of when the agent goes in and says, hey, these people, these minorities from the protected classes are moving into the area. Maybe you should sell now. 28. A broker verbally tells a homeowner, I'll start marketing your house this week, and post the listing online before a written agreement is signed. A few days later, the homeowner lists with another brokerage. The first broker demands commission. A, the broker may collect because an implied agency existed. B, no enforceable agency exists without written authorization. C, the broker may claim ostensible agency because advertising occurred. And D, commission is owed once marketing efforts begin. Well, hopefully you know that C and D are definitively wrong. This is not an ostensible agency. Again, ostensible agency is when you lead a third party to believe you're representing them and you're not. D says commission is owned once the marketing efforts begin. That is not true. You know you have to bring a ready, willing, and able buyer. All right, so here what we have is a broker verbally tells the homeowner, I'm going to start marketing your house this week, and he posted online before a written agreement. So they never had a written agreement signed, right? He wasn't really his agent, and then this homeowner list with another brokerage. And so this also doesn't even say, he lists, but it doesn't say that it is even ending up in contract, right? So let's look at A, the broker may collect because an implied agency existed. And let's look at B, no enforceable agency exists without written authorization. The answer here would be B, no enforceable agency existed without written authorization. Please understand that you do not all the time have to have written authorization. It depends on what state you are in to collect a commission, right? So it really just depends on what state you're in. But here, under the national law, there was no enforceable agency here. There was nothing that indicated that this person was their agent. 29, broker Terry represents both buyer and seller in a transaction. Both parties consent in writing. During negotiation, Terry discloses to the buyer that the seller will accept less than list price. A, Terry acted appropriately under full disclosure. B, Terry breached fiduciary duty by favoring one client's interest. C, Terry had to disclose that fact under the duty of honesty. And D, Terry maintained neutrality as required in dual agency. So what do you think here? Both people did consent to dual agency, right? And I think that this is a great question because it gives you an example of the problems with dual agency. This is one of the problems with it, right? And so the correct answer here would be B. Terry breached fiduciary duty by favoring one client's interest. Under dual agency, you're going to make certain disclosures, but there are certain disclosures that you're not going to make. And for example, the seller is going to take less than that price, right? The seller's having financial difficulty, so offer them less. No, you kind of have to maintain almost like this type of neutrality where you're not doing anything over this person or over this person, or for the benefit of this person or for the benefit of that person. B clearly says, by favoring one client's interest, and by them telling that the seller will accept less, they're clearly favoring the buyer over the seller. Number 30. A general warranty deed includes a covenant against encumbrances. After closing, the buyer discovers an undisclosed utility easement running across the backyard. A. The covenant is breached and the grantor is liable for the easement's existence. B. The grantor is not liable since the easement benefits the property. C. The buyer has no claim because easements don't count as encumbrances. And D. The easement is covered only by title insurance, not the deed. All right. In a general warranty deed, you're going to give all of these promises, right? Promises. But when we talk about utility easements, right, we all know that these utility easements are just kind of like there. They run with the land, right? And so you're not going to be in trouble, so to speak, or not be able to be sued if there was a utility easement for, let's say, Xfinity, or for, the power company or the water company, because we all have an expectation that those are just going to be there. And so the correct answer here would be B. The grantor is not liable since the easement benefits the property. Now, that is not always true, but it is the best answer here. This covenant is not breached. The buyer has no claim because easements could be encumbrances, right? Under C, it could be encumbrances, especially like an appurtenant easement. And then D, the easement is covered by title insurance, not the deed. No, it is covered by the warranty deed. But in this case, because it's a utility easement, it's kind of like we're not going to worry about it. Question number 31. An executory contract becomes executed. A, when all parties have fully performed their obligations. B, when one party accepts the other's offer. C, once earnest money is deposited. And D, when the broker delivers the offer to the seller. Guys, easy peasy. This is like, thankfully, the gimme question, right? The KJ low-hanging fruit. It's going to be easy here when all parties have fully performed their obligations. So we say at closing most often. Number 32. A grantor executes a deed but dies before the deed is delivered to the grantee. The grantee later records the deed. Which statement is true? A. Title passed upon recording. B. Title passed upon signing. C. No title passed because delivery and acceptance did not occur before the grantor's death. And D. Title automatically vested in the heirs. This is another one of those you just got to know, right? The grantor executes this deed and dies before it's delivered. And so, no delivery. That's simple as that. You must be alive at the time of the transfer. So the answer here is C. No title ever passed because delivery and acceptance did not occur. 33. Broker Allen authorizes salesperson June to represent a seller under an exclusive right to sell. June secures a ready, willing, able buyer, but before the sale closes, Allen's license is revoked. A. The transaction may close because June's agency with the seller remains valid. B. The agency terminates because Allen's license revocation ends the brokerage's authority. C. The agency remains valid until closing since a buyer was procured. D, the agency converts automatically to dual representation. Now, guys, this is really in a state where you have, brokers over salespeople. Just make sure, it's a broker over a salesperson. You're in that type of state. In that type of state, the answer, of course, is going to be B. The agency is going to terminate immediately when Alan dies, because who is the agency with? It is with Alan. Alan's now dead, so there is no agency. It's just like poor June in that situation. 34. A large luxury home is located in a modest neighborhood of smaller, older homes. When appraised, its value comes in lower than expected despite being in excellent condition. A, this is the principle of progression. B, this is the principle of contribution. C, this is the principle of regression. And D, this is the principle of substitution. Well, pretty easy definition. Big home, modest neighborhood. You guys are bringing my property value down. C, this is the principle of regression. 35. Buyer Chloe receives a signed and notarized deed from a seller, but never records it. A week later, seller conveys the same property to buyer 2, who records it immediately. A, Chloe owns the property because she received the deed first. B, buyer 2 owns the property because recording gives constructive notice. C, seller retains ownership until both deeds are recorded. And D, both buyers are tenants in common. What do you guys think here? This is making sure you understand the concept of constructive notice. Who owns the property, right? When you have these shenanigans going on, who owns the property? Guys, just remember this. The first person to give constructive notice owns the property. That's it. We don't care about when you gave him a deed and so forth. The first to give constructive notice owns the property. You can give constructive notice in one of 3 ways. You could record the deed. You could cultivate the land. You can move in. That's it. So let's look at the question. Who did that first? All right. So she received the deed. She never recorded it. Then buyer 2 records it. Boom. Buyer 2 owns the property. And so the answer here is B. 36. A broker tells a buyer that a seller will definitely accept an offer at full price. The buyer submits the offer, but the seller rejects it. The buyer sues the broker for misrepresentation, which is true. A, the broker is protected because the statement was opinion. B, the broker may be liable for creating an ostensible agency relationship with the buyer. C, the seller is liable because they rejected a full price offer. And D, the buyer has no claim since no contract existed. Sometimes you get these really quirky, weird questions on the test. So he submits the offer, the seller rejects it, the buyer sues, which is true. He didn't accept the offer, so there's no claim. Now, of course, a broker should never tell a seller, hey, they're definitely going to accept your offer. Is it misrepresentation? Yeah, he said more than he should say. But if you look at these answers, he's protected because of his opinion. That wasn't really opinion because he said definitely accept it. That's not really an opinion. B, there's no ostensible agency here. We already know, again, ostensible agency is when you lead a person to believe you're their agent and you're not. So B, let's throw that out. C, the seller is liable? No, seller can reject whatever they want to reject. So the best answer here is D. The buyer has no claim since no contract existed. What damages did the buyer have? You need to have damages. You can't just go around suing everybody. Can he just kind of maybe get rid of this broker? Yeah, he could. But besides that, that's probably as far as we're going to go. So the answer is going to be D on this one. These questions are not always, and questions and answers are not always perfect, right? They're not always hard-hitting. You have to be able to be a good eliminator also. Question 37, a buyer purchases a home built in 1975. After closing, the buyer discovers flaking paint and claims they were never informed of potential lead hazards. The seller says the home was sold as is. Okay, so the home was built in 1975. You need that information. Never gave a lead-based paint disclosure, and the seller's like, listen, it was as is. So A, no disclosure is required for homes sold as is. B, the seller violated federal law by failing to provide the required lead-based paint disclosure form and pamphlet. C, lead disclosure applies only to rental properties. And D, the seller is protected because the buyer didn't order an inspection. Don't get confused by these questions. Before 1978, you need to give a lead-based paint disclosure. Simple as that. Whether the person did their own house inspection or they didn't, or whether the house was sold as is or it wasn't. Don't get confused by any of that. Stick with this rule. Before 1978, give a lead-based paint inspection. If you don't, you're violating federal law. So the answer here is B. 38. An appraiser notes visible mold growth in the bathroom of a home listed for sale. The seller insists that the agent exclude it from disclosure, claiming everyone has some mold. A. The agent must disclose because mold is an environmental hazard that affects material value. B. Disclosure is optional since the mold is visible. C. The appraiser is responsible for disclosure, not the agent. And D. The seller may withhold disclosure if the buyer waives inspection. Here again, never pick an answer like D. You can just withhold it if they waive inspection, meaning you didn't inspect, so I ain't telling you nothing, right? Because we know that you have to disclose latent defects. But in this case, if they could see the mold, it says it's visible. So the mold is what? It's patent. Everybody could see the mold, okay? And so in that case, because it's visible, you didn't have to disclose it. So B would be the appropriate answer. Disclosure is optional since the mold was visible to everyone. It was patent in this situation. I also want to have you look at C. The appraiser is not responsible for disclosure. Okay, it's either going to be the agent or it's going to be the seller. All right, and A, of course, is incorrect. Must disclose. No. Answer here is B. You could disclose it if you want. Question 39. At closing, prorations for taxes, rent, and insurance are calculated by the escrow officer. Which statement is correct? A. The seller pays expenses in advance for the next tax period. B. The buyer and seller split expenses as of the day of closing. C. Prorations are calculated only for items already paid. And D, prorations are always charged entirely to the buyer. Well, you guys just think about it, right? Think in your head when you've done prorations in class and you've kind of divvied up between the buyer and the seller as of what date? As of the closing date. So that is real simple. The answer there is going to be B. Number 40. A new government facility increases employment in a nearby town, leading to rising home prices before construction even begins. This illustrates what economic principle? A. Contribution. B. Anticipation. C. Change. Or D. Substitution. So essentially, these home prices are rising before construction is even going to begin. Why is that? Because we're anticipating that in this area, there are going to be a lot of people, there's going to be a lot of activities, home prices are going to go up and get bolstered, right? So we are looking at what we call the economic principle of B, anticipation. And what we say is it's not necessarily what it's worth today, it's what it is going to be worth. All right, how did you do on that one? That was a pretty tough test, I thought. But let me know in the comments how you've done. So many of you guys, thankfully, have been passing with the KJ method. Let me know how this is all helping you. Don't forget to tell your friends all about the KJ method. And also, you could click that link below if you want a copy of the free study plan. And I will come back next week with questions 41 through 60. Guys, the other thing is vocab. Vocab. Keep practicing your vocab even though we're doing these test questions. Okay, guys, I'll see you next time.
Jumpstart your real estate career with KJ Method. Pass the exam with flying colors, only with KJ Method.